Types of entries for beginners guide to learn from scratch. Number 1 type of journal entry is opening entry. Opening entry is referred to as the first entry that is recorded or which is brought forward from a previous accounting period to the new accounting period. These entries carry over the previous accounting period's ending balance as the current accounting period's beginning balance. Consider the following scenario. After all liabilities for the preceding accounting period were settled, the closing balance of the cash account on the balance sheet was Rs. 11,000. The opening entry for the current accounting period is that balance of Rs. 11,000. In an ongoing business, the closing balance of the previous accounting period serves as an opening balance for the current accounting period. The opening entry will vary based on the business, and the opening entry can be either on the debit or credit side. Assets have a debit balance and therefore, assets are debited in the opening entry, while liabilities have a credit balance and are therefore credited in the opening entry. Example of opening entry. Here in this example, the debit balance is equal to credit balance, which is 63,500. Number 2 type of journal entry is transfer entry. To move or allocate an expense or income from one account to another, transfer entries are used. For example, Reliance Limited transfers cash from its primary account to a subsidiary account. A transfer journal entry accounts for the transfer must be made. There is no involvement of a third party in these transactions, and hence all transfers must be net zero. Number 3 type of journal entry is closing entry. These entries indicate the completion of an accounting period with a balance that can be moved from a temporary to a permanent account, or from one accounting period to the next. The closing entry in the case of temporary accounts zeroes out the account, and any amount remaining is transferred to a more permanent account. After that, the temporary account is closed. Expense and loss accounts, revenue, income, and gain accounts, income summary accounts, and dividend or withdrawal accounts are all examples of temporary accounts. When it comes to accounting periods, the closing entry indicates the account's final balance at the close of that period. The value is subsequently moved to the next accounting period starting entry. It is the accounting period for that account that is closed in this case. Closing entries are journal entries made at the end of an accounting period to transfer balances from temporary accounts, such as revenue accounts, to permanent accounts such as equity accounts. A temporary account is an account that is closed at the end of every accounting period, meaning its balance is $0 on the first day of the next accounting period, usually a year. Temporary accounts include all income statement accounts, such as revenues and expenses. Permanent accounts are those that are not closed out at period end. Their balances do not reset to $0 on the last day of the period. Permanent accounts include asset, liability, and equity accounts, balance sheet accounts. Closing out revenues. For example, sales revenue is $2 million on December 31, 2023, for a calendar year entity, but $0 on January 1, 2024. The revenue is closed to retained earnings, an equity account, at year end. Revenue accounts start with a $0 balance at the beginning of the new accounting year. Thus, sales will be debit and retained earnings will be credit with $2 million. This entry increases retained earnings, which is a permanent account. Closing out expenses. In another example, the salary expense account is $6 lakh on December 31, 2023, for a calendar year entity, $0 on January 1, 2024. At year end, the expense is closed to retained earnings, an equity account. Expense accounts start with a $0 balance at the beginning of the new accounting year. This entry decreases retained earnings, which is a permanent account. Closing entries are normally made automatically by a company's accounting software. Thus, retained earnings will be debit and salaries will be credit with $6 lakh. Number 4 type of journal entry is adjusting entry. Adjusting entries are entries that, in accordance with the accrual method of accounting, reflect changes to accounts that are not otherwise accounted for in the journal. According to matching and revenue recognition principles, these entries are entered in the general ledger at the ending of an accounting period. Accruals, deferrals, and estimations are all common examples. An expense accrual is an expense that is reported in an accounting period but not yet paid. Electricity used by a plant in the month prior to the utility issuing a bill for the firm to pay is an example. Work that has been completed or products that have been delivered but for which the customer has not been billed is referred to as a revenue accrual. When a payment is made in an accounting period before the item is actually incurred, this is known as an expense deferral. A payment made now for insurance that covers the next 6 months is an example. When a corporation gets money in advance for services or products that will be provided in the future, this is referred to as deferred revenue. Adjusting entries are often made at period end, for example, month end, to correct the company's financial statements, though they can be made during the period. For example, if company employees work 1 week but are not paid by month end, an accrual can be made to recognize the salary expense incurred. So, the company makes an adjusting entry, in the form of an accrual, at the end of the month. While adjusting entry is often used synonymously with the word accrual, they are not the same. Adjusting entry is broader than accrual and encompasses all entries made to record a company's activities. Accruals record revenues and expenses. On the other hand, adjusting entries include non-accrual activities such as depreciation, allocations, and bad debts, and accruals of revenues and expenses. Here are examples of adjusting entries: accrued expenses, accrued revenues, prepaid expenses, unearned revenues, depreciation, amortization, bad debts. Adjusting entries also encompass prior period adjustments. A prior period adjustment is an entry made to correct a prior period error. Suppose a company uses GAAP and does not record $45,000 in payables at the end of December 31, 2023, and records that amount as an expense in January 2024. Now, the expense appears in the wrong year, assuming the company has a calendar year end, resulting in an understatement of 2023 expenses and an overstatement of 2024 expenses. On July 2, 2024, the company discovers the error. So, a prior period adjustment is necessary and is recorded in December 2024. Now, let's look at reclassifying entries. Number 5 type of journal entry is compound entry. These entries record various accounts that will be debited or credited. The total of debits and credits must be equal, but the number of credits and debits does not have to be equal, according to the rule of journal entry. There might be 1 debit but 2 or more credits, 1 credit but 2 or more debits, or even 2 or more credits and debits. Payroll, for example, may involve a huge number of journal entries that may be summarized in compounded form. Number 6 type of journal entry is reversing entry. Reversing entries are created at the start of a new accounting period to reverse, or undo, an adjusting entry made at the completion of the previous period. This option reduces accounting mistakes caused by double counting expenses or income while also improving the efficiency of processing actual invoices in the next accounting period. To put it another way, they're utilized to make bookkeeping easier. Companies make consolidating entries when 2 or more entities are combined. Consolidating entries eliminate intercompany transactions. In consolidation, or combined, financial statements, the presentation should appear as though the 2 entities are one. So, revenues recognized in selling from Company A to Company B are eliminated when consolidating the 2 entities. Company B's expense, for these transactions, is also removed from the consolidated financial statements. Additionally, companies eliminate intercompany receivables and payables. That is, companies normally offset intercompany receivables and payables against each other. Consolidating entries are often made in a spreadsheet, for example Excel, with the 2 entities' account balances side by side and then additional columns to record the eliminating entries. The final columns include the adjusted balances for the financial statement balances. Some accounting software packages make the consolidating entries for you, and no spreadsheet is necessary. Number 7 type of journal entry is recurring journal entry. Recurring journal entries are those that are repetitive. Often, these entries are automated with the company's accounting software. For instance, if a company will pay $5,000 per month for rent for the next 3 years, the accountants might set up an automated entry. That way, the company doesn't have to make this monthly entry manually. Most accounting software packages provide for automated entries. Set it up once and specify the number of periods to make the entry. Then, the software will record an entry such as the following until the rental agreement terminates. Thus, rent will be debit and accounts payable will be credit with $5,000. Another example of a recurring journal entry is depreciation. If the company purchases a corporate office for $5 million and plans to depreciate it straight line over 50 years, it can create an automated entry of $8,333 each month. Thus, depreciation expense will be debit and accumulated depreciation building will be credit with $8,333. Number 8 type of journal entry is non-standard journal entry. Non-standard journal entries are those that are not repetitive. For example, they might be one-time entries or occur twice a year. These entries are usually manually inputted into the company's accounting software. Examples of non-standard entries include the following: impairment charges, writing off bad debt stock, buybacks, legal settlements, debt restructuring. Non-standard journal entries, such as those for mergers with or acquisitions of other companies, can be complex. Number 9 type of journal entry is consolidating entry. Companies make consolidating entries when 2 or more entities are combined. Consolidating entries eliminate intercompany transactions. In consolidation, or combined, financial statements, the presentation should appear as though the 2 entities are one. So, revenues recognized in selling from Company A to Company B are eliminated when consolidating the 2 entities. Company B's expense, for these transactions, is also removed from the consolidated financial statements. Additionally, companies eliminate intercompany receivables and payables. That is, companies normally offset intercompany receivables and payables against each other. Consolidating entries are often made in a spreadsheet, e.g., Excel, with the 2 entities' account balances side by side and then additional columns to record the eliminating entries. The final columns include the adjusted balances for the financial statement balances. Some accounting software packages make the consolidating entries for you, and no spreadsheet is necessary. Number 10 type of journal entry is reclassifying entry. A reclassifying entry is one made to move amounts between different accounts. For example, if a company has recorded an expense as miscellaneous expense that should be office expense, a reclassifying entry is made to debit office expense and credit miscellaneous expense. Doing so moves the expense from miscellaneous expense to office expense. This entry has no impact on net income. It only reclassifies the expense to the correct account. Here is the reclassification entry. Thus, rent will be debit and accounts payable will be credit with $5,000. Classification of amounts can be critical to accurate reporting. For instance, what if a company defaults on the debt covenants of a $9 million loan? According to GAAP, the debt usually becomes short-term. Why? The loan is callable by the lender, meaning the creditor can demand immediate payment. So, a reclassifying entry is made to move the debt from long-term to short-term. This reclassification entry has no impact on equity, only on the presentation on the balance sheet. Next, we explore closing entries. Thus, rent will be debit and accounts payable will be credit with $5,000. Number 11 type of journal entry is accruals and deferrals. When a company uses the accrual basis of accounting, it accrues and defers revenues and expenses based on when it earns revenues and incurs expenses. The company's activity, goods or services provided or purchased, drives the accounting. For example, if you are an attorney, you can recognize revenue as you provide services on a particular day, even though you may not receive the related payment until weeks later. And if you buy office supplies on the first day of a month, you accrue record the expense on that day, though you make the related payment 35 days later. Accruals are the recognition of revenues and expenses before cash is received or paid. In contrast, a company using the cash basis of accounting recognizes revenues and expenses as cash is received and paid. The receipt and payment of cash drive the accounting. Companies using the cash basis of accounting do not accrue or defer revenues and expenses. Accruals. Suppose a company receives an invoice from a CPA for audit services totaling $25,000, but it plans to pay the expense at the end of the month. The company can accrue the expense upon receiving the invoice. Cash payment. The company would recognize the cash payment when paid. The example of accruals and cash payments are given for idea. Deferrals postpone the recognition of revenues and expenses until a period after the one in which cash is received or paid. Suppose a repair company receives $10,000 for services on April 2, 2023, but performs the work on May 10, 2023. The company can defer revenue recognition until it provides the repair work. Deferred revenue is a liability account. The company recognizes the earned revenue when it provides that service on May 10, 2023. Another type of journal entry is an adjusting entry. The example of deferrals are given for idea by analyzing why cash is debit and deferred revenue is credit with amount $10,000 when transaction are done, but when amount received then debit and credit entry are different, that is deferred revenue is debit and repair services is credit with amount $10,000. Number 11 type of journal entry is proposed audit adjustments. External auditors sometimes propose journal entries to adjust a company's accounts. Auditors create the proposed audit adjustments to correct misstatements. These are provided to the company, and it decides whether it will record the entries. This is why they are called proposed adjustments. If the company does not record material proposed audit adjustments, the auditor may need to modify their audit opinion. Companies seldom desire a modified audit opinion. Kindly subscribe my YouTube channel Thesis Helper. Thanks for watching.